I'm super fortunate just to have these great CFOs join us. Nina Trentman from Bloomberg, she's been with us the last few years, and just I'm excited for us to really sit down for the next hour and talk a little bit about the leadership lessons that these three CFOs have had here for the last year. So thank you.
Great, thank you.
We need a mic. Oh no, we don't actually need a mic. I was about to say. Thank you very much, Jeremy, for that lovely introduction. Thanks for having me again. Nina Trentman, I'm a team leader at Bloomberg. Some of you might have gotten to know me in my previous capacity as a bureau chief for the Wall Street Journal. At Bloomberg, I lead a team covering investment grade companies, so basically all of you guys, as well as structured finance, ESG, and also LATAM and Canadian credit markets. Very much looking forward to having our panel discussion on leadership lessons. Just quick introduction, Carolina, up until recently the CFO of GE, who has been very influential in preparing and executing the company's three-way split. So we'll talk a little bit about that. Then we have Dan, CFO of Delta, who is actually a former colleague of Carolina, so long-time GE executive who's been in the finance function for a few years at Delta now and has been working to deliver the balance sheet as well as regrowing the business travel business. And then we have Greg here on my left, CFO of Honeywell, a company veteran. So he's been with the company for 17 plus years, if I'm
17.
correct. Honeywell recently got a new CEO, so I'm curious to ask about that.
Sure.
And then I guess we'll have room for questions from the audience. So also looking forward to those. So to kick us off, maybe each of you gives me sort of one of the biggest leadership challenges that you faced in your career and how you've resolved it in 2 minutes.
So maybe I'll just give it a whirl to start. I would say the last 5 years itself has been incredibly challenging. The amount of volatility that we've seen, people talk a lot about this time being different. I think actually the years leading up to 2018 were what was different. You know, zero interest rates, relative stability, and when you just go through this series of events that's happened, you know, over this 5-year period, the key lesson for me has really been about adaptability. I mean, we've had to adapt, it seems like, each and every year to 1, 2, maybe 3, micro crises from back to back to back. And so, you know, the lesson in my view and what's been so challenging for us, but I think what has served us well is facing into problems directly with pace, because I think as we would all agree, problems don't get better with age. And so dealing head on, with your issues and addressing them aggressively, I think has been probably the single biggest thing that, you know, I've leaned on in the last 5 years.
Cool. So I'm going to say, I think 2019, the situation at General Electric, $140 billion of debt, an industrial portfolio not performing in par with competition. And I'm going to say investors as well as analysts not very happy with the company and that showing up in the share price. So that was the challenge. And I decided to run towards the fire and join Larry. And what we did was delever $100 billion of debt, paid down. Most importantly, improving the performance of the businesses, and that's showing up in the financials. And then when those two things had happened, sort of figuring out what is the future, what's the best structure, and that was finding a way of sort of maximum sustainable value creation, which led to us deciding on the 3 spins and deciding that we were going to go into separating into 3 GE companies, all investment grade. I'm sure it'll come back.
Great. Probably for me, nothing like when you think about challenges and opportunities, joining an airline in the middle of a pandemic. Put that up at the top of the list.
We'll question your decision making later, but you know.
No, I was with GE, helping on that. So but whether it was that or even 20 years before that, in all different CFO and business leadership positions, I always come back to the three things when you attack these opportunities and challenges is always have clarity of strategy and purpose, hands down. Second, keep things really, really simple, especially in the finance where we can make things complicated. People want simple and consistent over time. And then the third element for me, when I look back at all these opportunities and challenges, it's about being connected. Connected with your teams, connected with the employees, and just making sure that you're giving them context and developing them along the way. So all those, they're just similar when I think about every phase of leadership going through, whether it's an opportunity in a growth cycle or a challenge, whatever it may be, just stay true to those three leadership elements.
I think, of course, things have changed a little bit since the pandemic. We came out of the pandemic and thought, okay, now things go back to normal or what they were before. And instead, we're seeing a multitude of challenges, including pretty high inflation still, wars in Ukraine and in Gaza, sort of tensions between the US and China, climate change. There's quite a few things going on here in the current situation. Well, how do you as leaders think about these challenges, and how do you make sure that your companies respond appropriately?
Yeah, well, we're all representing very global companies, and what I would say is that if you're a global company, there is always a crisis going on somewhere. There's always a challenge/opportunity going on somewhere. So I think it's making sure that the organization is set up to sort of, you need to have a tight connection between strategy and action, but you also need to have empowered leaders out in the business so that you can take decisions fast. And this is really sort of back to the agility point of being able to take the right decisions fast and adapt, because you're sort of controlling the controllable, but empowering people to do that, that are in the right spot to do that.
Yeah, and if I can build on that, I own crisis management for Honeywell, which again we've had plenty of that. To your point, and your point is knowing who makes what decision and how to activate teams is critical, because the worst thing you can have, confusion, and if people don't know who's in charge and who gets to decide what, you're right. Like, we're stretched all around the globe, so things are happening 24/7. And you use the word clarity. I think you're 100% right. Having that clarity and simplicity of knowing, who gets to decide what and when, just super important in times of crisis, which we seem to have every quarter.
Another thing I'll add is just being part of airline, we deal with these things, I think, all the time, and having spent 2.5 years with the team, having that, always that focus when you see something is control what you can control. And if you just always keep things, understand your strategy and purpose, but then focus on the things that you control, let the other noise fall aside, it really helps you drive execution and direction and really take care of your customers and your employees.
Yeah, maybe to connect to that, control what you can control. The recent increases in financing costs and interest rates were, of course, nothing that you as CFOs could control. How are you managing at a time of higher financing costs? I know that you all have maturities next year as businesses, and how does the higher for longer impact decision making in the finance function?
Yeah, I'll give it a start. I mean, for us, higher for longer, it's a reality for all of us. There's really nothing that you can do about it. Each of our circumstances, I'm sure, balance sheet wise, are very, very different. I mean, I didn't have a debt load to have to deal with, as Carolina did, of course. I actually view it as an advantage for Honeywell at this moment, because we have protected our A rating judiciously for 30 years, and so that has allowed us in times of stress to have access to capital at the lowest rates possible. Still not as low as they once were, but at the lowest rates possible. Which to us is a bit of an advantage. We went out in the market when the pandemic hit. We borrowed $6 billion, in a snap, just in case. As we think about the M&A environment right now too, zero cost of money was great for bidding up asset prices, and now that the cost of money is 5% or more, that actually is better for us, and we're in a place where we'd really like to deploy more capital towards M&A. So I actually view it as a bit of an advantage, Honeywell, in that context for us from at this point.
Actually, if I latch onto that before we get to Dan, in terms of deal making, when you said you would be willing to allocate capital, can you talk a little more as to which parts of the portfolio you'd like to grow? Would this be tuck-in or sort of a bigger transformational?
Yeah, so for Honeywell, I mean, we've talked about a bolt-on acquisition for us is $1 to $7 billion. When you're a $130 or $40 billion capital company, it's quite a bit different. So $1 to $7 billion deal size is where we would like to play. We don't think that transformational is required for us at this point. I mean, we've got 3 very strong megatrends that we're aligned to in the energy transition, the aerospace business, and also through automation, all that underpinned by digital. So we're actually very happy to do deals in each one of those vectors. They're very strong macro trends for a pretty long period of time. So that's the way we're thinking about it.
So
back to interest rates.
Interest rates and debt. When the pandemic hit, we weren't quite like Honeywell, where we were borrowing money just in case. As an airline, when 95% of your revenue goes away, those days of March and April, you're burning about $100 million of cash a day. So we had to take out the credit card and let the balance and debt structure evolve. The good thing is Delta had the wherewithal to be in the asset base to go out and raise that money. So we've been on this period of deleveraging. So we're using the cash that's coming in. We paid down over $4.5 billion of debt in last year in 2022, paid down another $4 billion this year, going after obviously the higher cost debt. And at the same time, we're buying all our new planes, and we're taking about $4 billion of new aircraft every year, paying cash with it, building what we call the unencumbered assets back up. We'll end this year with assets that are unencumbered by debt of over $25 billion, and have taken our leverage from the end of 22 from 5 times. We'll be right around 3 times this year, and looking to be between 2 to 3 times next year. And the rating agencies, one stayed with us, Moody's, through the process. They kept us investment grade. S&P and Fitch didn't look through the cycle. So we're working our way back to your neighborhood of investment grade. We're 1 notch away, but we got positive outlooks, and we're moving in that direction. So the focus really is on generating that cash, strengthening the balance sheet. We know we live in an industry that's going to have cycles, and you want to be able to have that fortress balance sheet so that you can always play offense through the cycle. And we were fortunate at Delta, we were able to do that. We accelerated, Ed and the team accelerated the builds of multi-generational facilities. Anyone that's been recently in LaGuardia, right in the heart when we're burning $100 million a day, the company decided to accelerate the development of a $4 billion project on behalf of our customers, because there was no better time to work on them than when they weren't full. Imagine trying to do that today in today's inflationary environment. Bold decision by the company, but one where it allowed you to play offense because you had the financial foundation to do that. And we're back on that track of moving down.
Do you have a sense, just coming back to the rating, as to when you would hope to be?
I think they're positively inclined. They've moved this year to within a notch with a positive outlook. So I would hope next year would be the time. It's hard to predict, a little bit dependent on the environment, but we think we're going to be our metrics will certainly be aligned to that next year.
Which of course is interesting, given that the universe of junk-rated companies is declining and there's more rising stars. Ford recently as one big issuer in IG in the junk. So, okay, I'm curious to see that.
Yes.
When that has
Thank
happening.
So Dan, you reminded me. So when I was joining in 2019 as a CFO, I did my due diligence. So I had sort of assessed the balance sheet, the businesses, and the team. And I said, yeah, running towards fire. What I didn't plan on was the black swan, COVID. So for us at GE, more than 100% of my total company cash flow came from aerospace aftermarket services, which is based on how much people are flying. And as you know, nobody was flying. So we shifted our focus from leverage to liquidity. As the CFO told me once when I was very young in the role, it's liquidity that will kill you.
Always.
So always priority number 1. So we did. But then over time, then we paid down the debt. And I would say, Nina, I'll tell you one thing. Having $100 billion less debt now certainly is a much better situation. I would say for us, we have said that we want to continue to delever. We've also said that all three companies will be investment grade, which also means that we continue to delever as well as improving the business performance. So that is clearly our priority number one now.
We briefly touched on China earlier. Of course, with you all running the finances for global businesses that have presence in the country or provide flights there. Just wondering how you're seeing the trade tensions between the US and China in your day-to-day work, and also if you're thinking of yourself as not just CFOs but business leaders, what is your role in navigating this conflict?
Well, I think we always, as an airline, we always adapt. Well, the one good thing about our assets are they're mobile and they can be redeployed. So no matter what's going on right now, unfortunately, even in the Middle East, we had to curtail activity into Israel since October, and probably won't be flying there through year end at this point. And we'll continue to evaluate as we go associated with that. So that's just something that I think is part of our DNA, and that you have to be able to be nimble and agile, but also keep the eye on the long term of where do you want to be, where do you want your network to be, your partnerships with airlines, so globally. So that's a big part of what we do.
Yeah, for us, as Carolina mentioned, our companies are so global. We do business around the world, and one of the things that's been really successful for Honeywell is we've tried to maintain as much as possible a local for local strategy. That has served us well, and will here in this case too. So we're not so overextended in terms of exposure to any one particular region from a supply chain and so forth. And so that's something that we feel has really helped for us. But your question about what do CFOs do? I mean, I think it's back to some of the discussions earlier. It's all of our jobs to make sure that we're looking at what's happening with a clear eye, and again, thinking ahead, thinking through what the potential outcomes may be associated with a variety of situations that we all have to consider, and make sure that we're catalyzing a conversation about it in order to be as prepared as possible for what may come.
Yeah, I think we're a combination of both, sort of local for local, very similar on the healthcare side. Our engines go wherever the planes go, so they move with them. But it's really about controlling the controllable again there, because what you do know is that things will change, and you also know that it's not what you sort of know that's the problem, it's what you don't know. So it's more about how do I manage the things I don't know, and how do I have a team that's ready to take decision, coming back again to who's the decision maker, what's the process, and how do you make sure that you adapt, because that's how you win, really.
Greg, one follow-up for you. You talked about scenarios and sort of being prepared for a variety of outcomes. Can you share any of the scenarios that you're working with?
I'm not going to get super specific, but as we think about next year, broadly speaking, there's certainly a lot of debate as to what the economy will do. I think many of the indicators that we all see on TV are lagging in nature. And I also think that there's a bit of a human nature for people to want things to be a certain way. You want to be hopeful. You wish for it to be good. So as we think about 2024, while we have a very strong support in our long cycle businesses and the backlogs in those, we're also preparing for making sure that we don't overextend ourselves on investments should maybe the short cycle businesses not recover as quickly. So I think you've always got to be optimistic, but realistic, so that you don't overextend yourself. Because the worst thing you want is to go into the first quarter, the first half of the year, and then you're trying to unwind decisions that you made because things turned out to be worse than you thought.
Now we'll come to the outlook for next year, sort of maybe towards the end. Just one thing in terms of technology and how you run your finance organization, automation, AI, ChatGPT have been topics here earlier this morning. I'm just wondering how you're thinking about those tools. Are you using any of those in the finance organization already? What are the advantages that you would see?
You use it to write your earnings script.
That's right. That's right.
To answer all the questions. You're not even. You
I'm
don't
not
even
even
have to
there.
do it anymore.
That's right. I'm not even there. It's just it's an apparition. Maybe I'll start. I mean, for us, the last 6-7 years, digital transformation overall has been incredibly important. That was actually Prior to me becoming the CFO, I launched what we called Honeywell Digital. And I mentioned that because AI is actually built on some elements of having a digital backbone. And so our ability to create an IT architecture, we went from 146 ERPs, now 95% of our company is on 4. And then we were able to build digital infrastructure around that. There's no way we could have done that around 146. But around 4, it's very possible. And with that, we've built, we built our enterprise data warehouse. So now we have something to leverage off of. Now for, ChatGPT or AI in particular, I still think we're very much, there's a lot that we're learning. So as much as everyone wants to, turn it into value immediately, we're looking at use cases, some of which were mentioned earlier this morning. But I think that's, you've got to go after it with some level of aggression and try to make something out of it, but at the same time, be conscious of some of the risks involved. And so we have, as we always do at Honeywell, we set up some form of a team to kind of govern how we think about that, including some of the aspects of, data, privacy, et cetera.
Well, I would say like this. I'll start by saying that I probably did something unusual because I was actually in a tech company, and then I moved to an industrial company when everybody else was going from industrials to a tech company. So I'm not sure what that says. As you said, we'll talk about that later with the decision making, but I did. But I also did it, and that was not GE, that was my previous company. I sort of saw the opportunity of what digitization can do to industrial companies, because it's actually amazing. And I worked a lot with lean and automation, or lean and digital, and you can do that in a manufacturing environment, which I know probably many of you have seen and worked with, but it's sort of just as effective on office work or transactional lean and digitization. So what I'm starting to see is now with, so if it's ChatGPT, but with sort of machine learning and deep learning, you're starting to see solutions that are much easier for the office environment to automate, which actually means, if you think about it, it's almost like the Industrial Revolution, what that did to manufacturing jobs on the floor, how we improved quality, safety, quality, delivery, and cost. We're getting into a phase where we'll have the opportunity of doing the same kind of improvements when it comes work-wise to the office environment. And it's sort of still early days, but we were joking about that the earnings script would be written by ChatGPT. I did text Amy Hood when they came out with it saying, are you going to help me with this now? I didn't, she said soon. But seriously, there's a lot of work that has not been the best part of all of our jobs that will go away so that we can spend our time on more important things and sort of on the action more versus the production of the information. So I believe there's a lot of opportunity in this. It's going to be step by step, though, because the ecosystem around it has to work. And you talked about the ERPs. There are a lot of systems and data that you need to transport to the right place so that you can actually use it. And people tend to forget that. They'll just want the bells and the whistles. So early days, but it's moving in the right direction and probably underestimated sort of in the longer term.
I think it's, I'd say underestimated. It's going to be quite exciting. When I think about it, the speed at which it's moving, it is early innings. It's probably where dot-coms were in, 99, 2000, 2001 timeframe, but I think its life cycle is going to be faster and how it grows. I look at an airline, the tremendous amount of data that we have. Think about how we run our operations every day. Not only how you schedule it, but when there is a disruption, how do you reschedule it and reset it? And the ability to use machine learning to do that is incredibly powerful. As you're out and we're providing inventory to you, right? Seats every day, and you're procuring and we're retailing with the customer base, what we provide you at the right time. We have extensive commercial teams, revenue management teams that manage that. They've always used a tremendous amount of data and analytics for this, but the scale and speed at which machine learning is going to enable them to even do it better and to provide to our customers. And we have big, think about any time you're traveling, whether it's booking a trip or as you're getting ready for a trip or in a trip and you need service and you need an answer quick, how we can self-service you with machine learning and analytical engines, or at least help our reservation specialists get to answers faster. So instead of having a call handle time of X, it's Y. And so it's powerful. It's powerful through the commercial, the operating side, but also in all your support activities and how you manage data and get to real insights and power of decision making.
Man, if I could just build on that a little, we have a business called our Honeywell Connected Enterprise, and we're providing those types of services to our customers. So think about the control room, that's controlling a petrochemical refinery. Well, we're turning that on ourselves. To your point, Caroline, I mean, digital operations is what we're after, internally. And so yes, we're trying to do predictive analytics to get to things. People were in love with, I have a dashboard for that. Well, how many people are like, I'll send you the dashboard, Greg, and the next thing I know, I have 1,000 dashboards coming my way. We're trying to get to the place where it's not really about dashboarding, but it's about alarms. What parameters do you want things to operate into? Can you define what those are and when they're out of tolerance? And then can you create analytical tools that are going to tell you, go look here, as opposed to, send us all dashboards and have to try to, work through them and figure out what the insight is inside that. I think that's where, we're all heading. And again, AI will play a role in that as well.
Carolina, you said something earlier when you talked about the three-way split, sort of making sure that you, as a leader, also enable people to make decisions, especially those that are on the ground. I would be curious if you could talk to us a little more about sort of how do you do that to separate a business as big as GE. Though you mentioned the 140 billion in debt, how does that work sort of to separate the balance sheet, the income statements, the different debts, how to make sure that you're allocating the right amount of debt to the companies so that all of them end up as investment grade, and also were there any lessons that maybe Dan or Greg could implement in their businesses?
So we have 300 ERPs that we're separating as a side note.
Still?
Part of the
that.
joy.
Good luck with that.
That's what we still
That was
have.
my history. I don't want
But
it.
at least we have much less debt. So that was sort of a prerequisite to get down to a debt level that was.
You had to choose either the ERPs or the
Yes.
debt, right?
Yeah. So I got my fair share now on the ERPs, but I did get the debt down. Okay. So I would say like this: when we had enough progress on the balance sheet and on the business performance, because we needed both to sort of look at the optionality of what can we do, and frankly, what do our customers need and want. And we had aerospace, we had energy, and we had healthcare, which are sort of pretty separate end customers. I would say what we did then was to say, okay, what's also important is that 95% of the company is focused on BAU, and that's short then for business as usual. Because you do need this huge company to continue to work every day to serve our customers and the customers' customers, not to lose momentum, because the performance and development of the performance was the most important part. So that said, we said, okay, 5% will focus on the spin. And I would say out of those 5%, it's probably 80% is finance and IT. So out of the corporate team, what we did was we put in an SMO or a PMO with 2 leaders, and they're 2 of my team members, my treasurer and my corporate CFO. And then we basically organized it in 9 work streams. And they were led sort of by different leaders. And then we had sort of subgroups below that. And then we also, which I think was really important, we also said, okay, so how do we make sure, because there's an enormous amount of decisions that need to be taken. Some much more important than others, but you still need to decide those thousands legal entities, thousands of bank accounts, by the way, and guarantees and what have you not, that needed to be separated. And that's from a balance sheet perspective. You also needed to do basically annual accounts, filings, equity stories. There's a lot of different work, but it was important to sort of not only have the work streams, but then also have a hierarchy structure where we had what we call the SLT, SMO team. So basically Larry, CEO, and the team, what needed to go there, what needed to go to me and my team, and then what could be delegated to very strong members of our corporate finance team to take those decisions. And I would say that was really, really important because of the sheer amount of decisions that needed to be taken with speed. You think, when we announced, we said, okay, we will do both spins within 2 years. And it's probably one of the most complex legal entity structures in corporate America to start with. So even that time frame needed a lot of decisions with speed. And you want high quality decisions. So that's why it was so important, this separating what needs to go sort of on a strategic level with decisions, what goes on a CFO level, and what can be delegated to the working teams in the company, and very, very strict follow-up on the different parts. Because what happens is things you didn't know pop up, and you need to adapt pretty fast. And that also made it possible for us to then move forward with everything from the ERPs, but also on the really important parts, saying what should the balance sheet look like for each of the companies? Because there are 3 very different businesses. Based on investment grade, it also means different things, because of the sort of the structure of the industries as well as the business itself, but also management teams. We needed I needed 3 CFOs, I needed 3 controllers, 3 of everything. So there was also a big talent piece in this, but I do think that was sort of key. Only 5% works with it, mainly corporate finance and DT, and then the hierarchy of what decision goes where, and a lot of follow-up.
And remind us, the final part of this, the split is going to happen second quarter of next year? Or?
Yes, we've said early second quarter, so basically in April, yeah.
Okay. Well, I have tons more questions, but I'm aware that we're sort of running out of time, so Paul is the timekeeper for me here. Before we open it to the audience, maybe one more thing in terms of climate change. Of course, an issue that impacts us all and that impacts your businesses. We can discuss, of course, what it caused it or what needs to be done about it. But I think also, of course, it's pretty clear that sort of taking action against climate change does cost money, or does it at least mean being willing to forfeit certain revenues in order to reduce carbon emissions. I'm curious to see how you as CFOs, of course, very focused on making sure that the cash is coming in and that you're managing your finances well, how you're thinking about that dynamic between protecting the climate, but also then making sure that you continue to retain your role and then shareholders are also somewhat happy.
Yeah, I'll start on this.
And
with
of course
Delta,
the airline industry
airline.
It's,
Our planes do produce carbon due to
We're working
jet
on
engines.
it. We're working on it.
So we don't want you as customers to have to choose between seeing and experiencing the world and saving the world. And so for us, it really comes down to as we fly, how do we fly in a more carbon-friendly way? And the good news is the jet technology is there where things like sustainable aviation fuel can be burned and combusted and done it much more efficiently. The question is, how do we develop a supply chain and a capability to produce the level of sustainable aviation fuel that the industry or we would need? So we're spending a lot of time making sure that because it's going to take an ecosystem. This is not the airlines on their own. It's with the airframers, it's with the engine makers, but it's also with the oil and gas industry, with government supports around the world, both at the national level and at the local level as it relates to incentives. Other industries have benefited from, whether it's EVs, whether it's wind and renewable technologies that came down those technology curves. Sustainable aviation fuel has to too. Right now the cost would be exorbitant. It would be $7, $8, $9 per gallon versus $3 today for jet fuel. And that's probably something that the consumer isn't willing to pay today. But I believe as we continue to work with this ecosystem and people come down and technologies evolve and feedstock technology evolves and we find new ways of producing it, just like those other industries got to cost competitive, the sustainable aviation fuel will too. So that's one of our primary focuses, something we're committed to, looking at it both short, medium, and long term, but making sure that we have a portfolio approach to it.
So Honeywell's been a sustainability company for a very long time. Since 2004, we've reduced 90% of our own greenhouse gas emissions. So for us, this is not necessarily super new. And in fact, if you think about our portfolio, about 60% of our revenue and our R&D goes towards ESG-oriented solutions. So you mentioned sustainable aviation fuel. Our technology is actually germane in allowing that to be created from a number of different feedstocks. So for Honeywell, we've got our own net zero commitments by 2035. We're spending around about $50 million a year on our own CapEx to support our plans. But we also feel like we're here to help solve some of those big problems ourselves. So to us, it's as much an opportunity as anything else because the things we're bringing to the world are to help solve some of those challenges.
Yeah, I would maybe just add to that, having been based in Europe for a long period of time and in Germany, sort of sustainability has been on the radar a bit longer, so it's sort of been part of the discussion for longer. And I would say all companies are moving in the right direction. It's sort of the speed with that, how fast can we do it, sort of to manage our customers and our financial commitments, but it is moving in the right direction. And Dan, you mentioned both, for us it's energy transition, it's SAF with the fuel, but it's also about the healthcare, sort of in the healthcare sector and affordable and accessible healthcare. So definitely working in that direction as well.
You all work for global big corporates. I'm just wondering how you as CFOs make sure that your leadership style aligns with that of the company's management, as in CEOs, as well as boards. And also, how do you sort of make sure that your people in finance are working according to that? And then we'll open it to the audience.
Yeah, but I can start. So I would say like this. One thing is sort of the strategy to action, and that's sort of what you're going to do. But how you do it is more your leadership. And I would say, we all grow through different roles that we've had. And for me, having worked in a sort of a system which was very successful in a very decentralized way, but where the accountability was very clear, so sort of decentralized, empowering teams, but also very strong on the accountability. And then adding sort of lean to that and taking those decisions fast, close to where the action is, I would say, if it's customers or if it's the products. That has definitely made me a big believer of that. And I do think this about empowering people and building as strong teams as you can. I'm sure my fellow panelists will agree. When you're in these large companies, it's about what your team will deliver. It doesn't, I'm not going to say it doesn't matter what you do, but it's really about cheering on the team so that the team delivers, because it's the sum of what they do is really what's going to create the real impact. So it's about getting a strong team as you can and empowering them, but being also clear what success looks like, so that we all pull in the right direction. And I think that's worked really, really well.
For me, also switching companies just after almost 30 years with GE, going into Delta, the last 2.5 years, certainly as you're assessing joining a company, I grew up in one company, assess another company, corporate culture is important to that underwriting process, but until you get in, you don't really know the corporate culture. But that is what bounds the leaders, across the Delta leadership. The corporate culture bounds us, but we also all have our unique leadership styles and personalities that we bring to the table. We respect each other's related to that, but I think it's that collaboration. But for me, one of the big parts of that is really keeping your feet on the ground as it relates to the operation and what's going on. And the way I not only serve Delta, but serve the finance team is really spend a lot of time out in the operations, whether it's with our frontline leaders as it relates to how our airport operations going, is it in our maintenance operations where we've got 12,000 technicians every day that are ensuring that the aircraft are safe and doing all the maintenance work associated with it, whether it's our crew resources. The more that you understand that and have a deeper appreciation of how that work's done every day, I think that's what you bring to your teams, and that's what you bring to the leadership team in decision-making and context, so that you can collectively bring your ideas together to really drive the company forward.
Greg, you have a new CEO?
Yeah. Listen, I'm in alignment with everything the guys have set up here. I think, CFO as COO is kind of our mantra, which I think aligns with a lot of what you guys are talking about. And, for us, I have a very consistent message to my finance team around, we wrap everything we do every year around controls, driving business performance, and leadership development. Again, it touches on team. Without the team, you're never going to be successful. And back to CEO, we're servants of, our leaders, right? If you ever forget you're there to make your boss successful, it's probably time to go do something else. I heard some of the earlier panelists talking a little bit about that. But I think you have to find where that fit is. When Darius was the CEO. He had been in the role for a couple years when I came in behind him. He needed certain things from me. A big part of that was driving the digital transformation. Now, Vimal is a new CEO. He's been somewhat exposed to the external environment, but not nearly as much. So my role with him, he knows the company super well. So my role with him is probably right now being a little bit more on the external side, and then making sure our operating cadence continues to perform while he's coming up whatever learning curve that he needs to come up to. So I think you have to adapt your style and what's needed based on the circumstance, the partner you're with, and again, back to being adaptable. I think that's an important aspect of it, because you have to fit a bit hand in glove with your leader, the board, et cetera.
Yeah, manager alignment.
Yeah.
I'll open it to questions, I guess. I hope we have many. We have a few mics in the room. Paul is there, and we also have a mic here in front with Priya. Don't be shy.
I'll ask the first question if no one's going to ask. Yeah, I'll need the mic. So I think a lot of your roles are about communication with the external environment. I think this one is maybe for Dan in particular, is just to give us some insight on the Sky Miles and
I actually had that on my list of questions, but it's good that you're asking.
as a Delta Sky Miles member, I'm just curious your take of it. So,
Well, the wonderful thing is that
The important things.
really appreciate that question. But as you can see, we've evolved, and the amazing thing is that the response that we got was just shows you the passion that people have as customers and loyalty to the brand and what it's all about. And it provides a great learning for our teams to listen deeply, and our teams did, and they reflected on what they heard, and we made adjustments. The other thing that you know is that the demand for this product, the amount of people in our premium level of service is almost 2x what it was in 2018 and 2019. So we don't even have the assets and capability of clubs or seats and those types of things to fulfill all the premium demand. So again, we were focused on the long term. We probably went a little too fast, and we had to pull that back. But I think what it allowed us to reflect on is, one, is it's really important to listen to your customers deeply and understand what they're on their mind. That helped better inform us to how far to go. And it also reflects just on how passionate and deeply people care about the brand and what we do every day. So thank you as customers.
Okay.
Hi. As a global company CFO, how do you and when do you get involved when you're assessing an M&A transaction? And second part of the question, with how fast technology is evolving, how do you assess a highly technical, technology-driven company when they do not actually show the traditional financial results you would be looking in a transaction?
I'll start unexpectedly, maybe, because at GE, with the portfolio, it's been more about selling to get to those 100 billion. But previously, over my 16 years, almost as long as you've been, at Assa Abloy, I was known as a serial acquirer because I did actually 200 acquisitions. So I remind people of that when they talk about only selling. So if you're going to we did 15 to 20 deals per year. If you're going to do that successfully, and we did have successful integration over many years, you do need a really strong process. So it was basically, in corporate we had a toll gate process, basically sort of the deal initiation. You'd look at strategic fit, then you'd start to look at frames, we call it SPA frames, so basically frames of the financials, then a DD, and then a final sign-off. That was at corporate level, corporate CFO. For the segments, they basically had the M&A, I call them M&A guys, gender neutral, but M&A experts. We had them internally, and on the segment level, they were responsible for executing the transaction. So the segment CFOs, the deal initiation was still from below, But once they got sort of the green lights on the different toll gates, they could then execute on the transaction in that process. And then out in the businesses, they were responsible for deal generation. So the CFOs that were out in the businesses, together with the business leaders, would then be responsible for knowing their own strategy, the strategic fit, and then basically flagging that this would be a deal that they would like to do, but they did not have the full responsibility or capability of executing the transaction. So it's very clear what was done on corporate, what was done on segment level, and what was done on the business level. And by doing that and having a capital allocation structure that was really clear, it was easy to say no, and that was part of the success. Because if you buy 15 companies per year, you're looking at 100, and you say no to a lot of companies. Yeah. Many of them came back years later. Some did as they said they would, some did not. But you'd find sort of the right point in time when you would do those deals. And your last question was, what about technology? Well, I would say there are different types of acquisitions. You can have an acquisition that is, I'm going to say, more of an installed base. It could be sort of a geographical expansion somewhere. But it could also be on the product side and on the technology side. And then, as part of your sort of framework, you have to assess what does that technology bring to your existing products, and what do you see as the opportunity in growing with the synergies. And that is you don't look at the technology itself. Yeah, you need people to assess that it works as it's supposed to work, but it's more important is what is it going to do to your existing products and solutions so that it creates value for your business. And sort of that's how the CFO thinking would be around that.
One thing I'd just build off of Carolina's point is you said, when do you get involved, both through my career, but also a board that I sit on. It is really very early in the strategy and having M&A game boards. And you're never surprised, but you should never be surprised by a deal. You may be surprised that something's transactable that was on the game board when it wasn't, but you shouldn't be surprised by what you're looking at and the fit with its strategy. So I find that teams that do it really well are ones that have a strategy, they have an inorganic game board, they have a criteria for it, there's a set of targets out there, but they always fit a certain rationale. So then when you see an opportunity, it fits right in there and you're involved from day one.
And then you can move faster.
Yes.
Because you sort of know it fits.
Yes.
And it's about the deal math.
And it makes some of the meetings really short when they don't have that. And they come in, like that's, to be honest, some of the worst deal meetings are when they don't lead with strategy and they just show up with a shiny new toy and say, hey, I learned about this thing and I'd like to go, buy
It's for sale.
It happens to be for sale and we think we can access it. But two other things I would mention. One is, Honeywell has a venture capital arm, and I believe GE does as well. I don't know if Delta does that. That's actually something that we've done, and we're making small investments, small VC investments to learn more about technologies as they're developing, because it isn't the same as buying something. The traditional Honeywell acquisition is buy something that looks similar to what you have, that how that business model runs, and you strap it on and create scale. Well, in a technology acquisition, it doesn't work that way, at all. And so what we've done in our VC fund is take positions to be able to learn. One of those was a company called Cambridge Quantum Computing, and that became what is now part of our Quantinuum quantum computing business. And so we learned a lot about it before we were ever, ready to go into, in this case, a joint venture arrangement. But I think that's one element. The other one is you have to have your technology team really deeply evaluate that technology. In every deal we do, there are a certain set of must-believes, no matter what type of deal it is. But in these technology areas, now you're going and doing serious diligence as best you can about what that technology does. Does it deliver what it said? Is it actually contemporary or not? And these are some of the things. So you're looking at a little bit of a different, set of considerations. But always, there's got to be a few must-believes, and it's got to be tied with your strategy, or else the conversation is basically dead on arrival.
I'll just add, because you said, when do the CFOs get involved? I just wanted to add, we also stay involved. Because once you've bought the company, it's about delivering that business case, and this is about the decentralization and holding on to the accountability. It's just so important. Because it's clearly with capital allocation, it's sort of good capital allocation over time is how you win, right? So making sure that those, in theory, good ideas, where the strategy is there, the deal math works, the integration, the operational sort of driving the operational integration, it's so, so important, because that's really where the difference is made in my experience.
That's right.
I'm Sarata McKay, and I'm a Chief Accounting Officer at Vapotherm, a medtech company. And in the medtech industry, the very natural trend is for the companies to get acquired, and there's a lot of consolidation. So if you could talk a little more about specifically the GE split and how that decision was made, and in general, how would you go about those types of decisions where you actually spin out parts of the business? Does that actually cut out the cost out of the business? Appreciate your insight on that.
Yeah, so I would say like this. When we were looking at what we could do, we had to start with sort of where was the balance sheet, how are the businesses performing, but then it quickly became, what do our customers want? What makes sense? Is it important for Dan that we have healthcare and energy, or is he happy with us having aerospace? So basically, we decided that aerospace separately from healthcare and keeping the energy portfolio together. Because you have to think about it, within these businesses, there are a lot of different P&Ls also within them. So those are groups of businesses that we decided to group in those three. And it was sort of based on the customers as well as, I would say, other stakeholders as well. Because it was also clear from investor perspective that they preferred sort of focused standalone companies to invest in. And I would say the combination of sort of the different pieces there were what led to us separating into those three companies. And then why it took 2 years? Well, part of it was the technical separation, but part of it was also improving the balance sheet and the performance so that we would have strong investment grade companies so that we are there for the next 130 years within all of those three businesses with our customers. And once you have that sort of decided and you know that that's the goal, then it's a lot of execution sort of from there to early next year. But that's sort of really the thinking behind. It was not really about costs or sort of synergies or dis-synergies. We actually managed to, within the cost structure of GE, to say we won't have dis-synergies. Each of the companies will be a public standalone company with a corporate. But because we had such a large corporate to start with, we could actually separate into three without dis-synergies. But key was customers, and I would say investors and other stakeholders, really.
And for Honeywell, I mean, we look at our portfolio each and every year. We talk about trying to be our own activist investor. We also spun off three companies, our chemicals business in 2016, our turbocharger business, and our Honeywell, gosh, I don't even remember it anymore, the thermostat business in 2018.
Oh, yeah.
But to your point, like
quickly you forget about your sibling.
I know, exactly. But to your point, you have to be really thoughtful and look at it through the eyes of an investor. It's not about whether we feel good about the portfolio or not. Is it delivering value? Is the sum of the parts greater than what the value that we've created across the company? And as long as that remains true, then we stay together. And if it's not, then we may bring ourselves to that same set of decisions again. And Carolina, to your point, I mean the breaking up of the company is just the beginning. You do have to deal with stranded costs as you're taking revenue and sending it out. You're potentially deleveraging your margin rates from a fixed cost perspective. And so each one of those decisions comes along with a stranded cost effort to say, how do I streamline what's left behind, because you're not there to destroy value in the RemainCo as well. So there's a lot that goes into not just that decision, but then also, to your point, the execution.
I'm getting the signal from Jeremy that we have space for one question before we need to wrap it up.
Mike, so I think it's going to be me. I'm Hannah, Chief Marketing Officer for the only insurance company parked outside the door. As people that deal with both numbers and people, where do you feel most comfortable at the end of the day? Dealing with the numbers or dealing with the people?
For me, it's people. My perfect day is actually being out in the operations, not sitting in a conference room looking at spreadsheets or dealing with numbers. When I've spent a day or part of a day out with our operating teams or with the customers and the experience, whether it be in the Atlanta lobby or in our maintenance operations, those are absolutely my best days.
I just want to say, we're CFOs, but we're also humans. So we do appreciate to be with people. For me, it's also people by far. I think it's a little bit of a personality, and Dan, you have a similar, like me, you're sort of growing up in the business in an operational finance role, so you're really close to the business, and then you add the strategic side to it, sort of on the corporate side with the capital allocation and so on, but sort of you have both those skill sets, but in the end, again, we're humans, so it's going to be people.
Yeah, similar. As I mentioned, controls, driving business performance, leadership development. Succession planning is, it's one of the things that I feel I owe the company as much or more than anything else to make sure that we deliver the world-class finance organization that the company deserves in order to carry out its mission. So, spending time with the people, spending time on succession, those are actually, a long time ago, a leader told me, Greg, as a leader, you really have, I'm going to oversimplify it, but you have two things to do. One is pick the people, the other is allocate the resources. Overly simplified, but that pick the people thing, it's actually A, really hard, and B, super important. A great decision, you're going to celebrate, for a very long time and feel thrilled about the added benefits that come along with that. But if you get it wrong, you're quickly unwinding it, having to do it over again. It's painful for you. It's a difficult decision for maybe the person that you hired. It's going to affect them and their family. So those are super important decisions that we certainly don't take lightly at all.
Well, thank you very much.
Nina, thank you.
Thank you,
Yeah,
Nina.
great
Thanks for coming.